Ivan, it's Erin Hawk. I have the slides up, and I think you're muted.
All right. So good afternoon, everyone. My name is Glenn Shoemate with Construction Employers Association, and we will begin our webinar for today, May 27th. We appreciate your interest in the topic and the opportunity to hear some of the updates on the payroll protection program. The timing for today's webinar we felt was important because many of the companies who may have received loans that opened April 3rd are about to reach that 8-week period, either at the end of this week or early next week. And so with recently issued IRS guidance, I guess just as recent as this morning, there was some additional information shared, and yesterday, I think there were some interim final rules that included information on the forgiveness loans and revised calculations, good faith loan opportunities, as well as the SBA's loan review process. Again, we feel that today's webinar will be timely and important. It is anticipated that the House will pass a bill to extend the 8-week period for businesses to use their funds, but that has not happened. Both House and Senate will have to take that up. And they're also, I guess, considering the ability to allow businesses to repay loans over a longer period of time. So we appreciate your interest. Just continue to encourage anyone that's interested in additional COVID coronavirus updates to visit the CEA webpage, where we do regularly post updates. We also share links and PowerPoints for all the previous webinars actually on that page. And I'd like to also give a big thank you to our presenters today. Ivan Golden, who's a partner with Han Lozier, works in their Chicago office, and then John Forbes, who's the managing principal for HW and Company here in Greater Cleveland area. Both have presented on this topic probably about 2 months ago, and we felt again that it'd be good to have them share updated information. Again, I'd remind everyone to mute your speakers with the exception of our presenters. We will now get started with the presentation. For anyone who has questions, there is a chat function that you can, if you're on a PC, there's a little bubble in the upper right-hand corner where you can enter chat questions, and we will incorporate some of those questions presented to the actual presenters today. So again, we will get started now with Ivan Golden from Han Lozier starting us off.
All right. Well, Glenn, thanks very much, and thanks everybody for joining us today. You know, as you said, this has been in some ways a frustrating program because we continue to receive new guidance and changes to the rules, even as the loans have already been, you know, out the door for, in some instances, several weeks, and even approaching the end of the 8-week period. And we now, you know, fortunately have a lot more information about the forgiveness application process, as well as, you know, what specific expenses will qualify for forgiveness and which will not. And so we're going to be talking about that today. And then as well, at the end, I'm going to talk a little bit about another program that may be helpful for borrowers who either already have PPP loans but need additional funding, or for whatever reason could not qualify for a PPP loan. So I want to begin by talking about this, you know, cash versus accrual concept. In the actual PPP statute, there's a reference to, you know, the costs incurred and payments made during the covered period, meaning that the general understanding until just a few days ago was that borrowers could get, generally speaking, forgiveness for, covered expenses and qualified expenses that they made during the covered period using PPP loan proceeds. And the covered period, as Glenn indicated, for now it's 8 weeks. There is some pending legislation that would extend it perhaps to 16 weeks, but at least as of now, it's still 8 weeks. But there was a question, really from the very beginning about, well, was that a cash method concept? Was it accrual method? Did that mean you could spend the money, as long as the money was spent during the period, it didn't matter, to what expenses or employee services it related? So now, fortunately, we have a lot more clarity and a lot more answers on that. So what the latest guidance said is that payroll costs that are paid or incurred during the 8-week covered period are going to be eligible for forgiveness. And borrowers can request forgiveness for payroll costs that are incurred on either, or that are for the 8-week period beginning rather on the date of disbursement of the loan, meaning the day that literally the funds hit the borrower's account, or the first day of the first payroll cycle in the covered period. So just for example, if a borrower hypothetically received a PPP loan today, May 27th, and their next payroll was, let's say, May 29th, and the first day of their next payroll cycle was the 30th, and generally, as long as they have a biweekly or more frequent payroll cycle, they could elect to use that first day as the starting point for their 8-week period. The other thing to keep in mind here is that because of the way the rules, really have a pretty borrower-friendly approach by saying paid or incurred, you can effectively include all or most of an additional payroll period within your 8-week period. So for example, if I get my PPP loan proceeds today and I have a payroll this coming Friday, and that payroll in all likelihood relates to, a period that was mostly or entirely prior to the actual payment date, I can still, under the latest guidance, I can still use PPP loan proceeds to cover that payroll, at least to the extent that individuals aren't earning more than $100,000, and I can get full forgiveness for it, even though it largely relates to prior periods. So, as I said, these are pretty borrower-friendly rules that we've just gotten. So if we can go to the next slide. So, as I said, payroll costs that are incurred on the last pay period. So generally speaking, I'm almost going to sort of flip these bullet points, but generally, payroll costs have to be paid during the covered period or the alternative payroll period to be eligible for forgiveness. However, on the back end, there's also a forgiving rule which says if you have a pay period if your pay period that falls within your 8-week covered period, but the actual pay date is outside of that period, then you will still get forgiveness with respect to the amounts paid after that period, as long as the amounts are paid on or before the next regular payroll date. For this purpose, payroll is considered paid on the date that checks are distributed, and payroll is considered incurred, or costs are considered incurred on the date that an employee's pay is earned. We did have an additional clarifying rule that said that for employees who are not performing work, perhaps because the employer is closed or there just isn't a demand for the work currently, Can folks go on mute if you're not? Sorry, I'm just getting a lot of like interference on the line. So for employees who are not performing work but are continuing to be paid, payroll costs are considered incurred according to the borrower's typical schedule. So if somebody is not working, they are sort of, but being paid, they're sort of deemed to be being paid for services performed according to the employer's normal payroll schedule. Aaron, can we go to the next slide, please? Okay, so here's an example to kind of walk through it. Hopefully this will help people to understand it. So, and this example, incidentally, comes directly out of the interim final rule that the SBA published just a couple of days ago. So assume that you have a borrower who received its loan on June 1st. They would then have a covered period that begins June 1st and ends July 26th. This borrower, we're going to say, has a biweekly payroll period. Their first full payroll cycle during the period begins on June 7th. That borrower can elect to have what's called an alternative payroll covered period beginning on June 7th and ending 55 days later, a total of 56 days, which in this instance would be August 1st. All payroll costs that are paid during that alternative payroll covered period will be eligible for forgiveness. And then any payroll costs that are incurred, which again means they relate to services performed, that are incurred during that alternative payroll covered period, also are eligible for forgiveness as long as they're paid on or before the first regular payroll date after August 1st. So if it's August 3rd, August 4th, August 9th, whatever it might be, it falls outside the covered period, but the cost of that payroll is still included. Aaron, let's go to the next slide, please. Okay. We also got a little bit of additional clarity on what payroll costs mean. Obviously, there's the obvious, cash payments to employees for salary and hourly wages and so forth. The additional guidance that came out within the past few days tells us that it also includes salary, wages, and commissions to furloughed employees, as I mentioned. I don't think that should come as a surprise, since a huge part of this program is to keep people on payrolls, even if there isn't much or any work for them due to COVID-19 and the various state shutdown orders. Payroll costs, we're also told in the latest guidance, include specifically bonus and hazard pay. One of the things that I've heard sort of batted around by a number of different clients or other people is, if you're short of, if you don't have enough payroll expense to be able to use the full amount of your proceeds, can you pay people bonuses or hazard pay, or however you want to sort of describe it? Can you pay people extra to allow them to meet your full your full amount, or at least get closer to it? And the answer to that now clearly Hi. Can people? Somebody's got a dog. It sounds like. So I'd appreciate if you could mute whoever has the dog. So there is this limitation on you cannot use PPP loan proceeds to pay compensation in excess of $100,000 annually or $15,385 per employee for the 8-week period, which is it's just the prorated amount. And then similarly, the guidance tells us that owner compensation replacement, you can use, if you have a PPP loan for either a sole proprietor or a partner in a partnership or a member of an LLC, at least one who is active in the business, you can use loan proceeds to pay that person up to $15,385 for the covered period. There was a question that I know has come up for me in practice in a couple of instances where a business owner owned multiple businesses, was drawing compensation from multiple businesses, and asked, well, can I pay myself that $15,385 2 or 3 or 4 times because I have multiple businesses? And the answer to that now clearly is no. You can only get the $15,385 per owner across all businesses. I see there's a question about bonus and hazard pay. Just to repeat what I said earlier, there was, I think, a question before about, if a business didn't have enough payroll to pay its, to use the full amount of its loan proceeds during the covered period, could it pay employees bonus or extra amounts and have that qualify for forgiveness? And the latest guidance that came out from the SBA just a few days ago now tells us clearly that the answer to that is yes. Again, though, obviously subject to it can't exceed $15,385 per employee for the covered period. So let's move to the next slide, please. Okay, the other thing that the other, I guess, large category of expenses that PPP loan proceeds can be used for are the non-payroll costs. So these are mortgage interest, rent, and utilities. And again, we get a very favorable rule from the SBA that really is very forgiving and takes a kind of, it's a incurred or paid rule effectively, which is broader than the statute. The statute seems to say, that they have to be both incurred and paid. But instead, the SBA guidance says that these costs are eligible for forgiveness so long as they're paid during the covered period or incurred during the covered period and paid on or before the next regular billing date, even if the billing date is after the covered period. And I will just add, many of you, if you are either attended our previous webinar or if you're familiar with the program, many of you may know non-payroll costs cannot be more than 25% of loan proceeds and may not be more than 25% of the forgiveness amount. The SBA's thinking in this regard is that program exists primarily to maintain payrolls, and as a result, they want to see at least 75% of proceeds used for payroll. So if we could move to the next slide, please. There's an example here, which again is straight from the regs. Many of the facts are quite similar. Assume you have a borrower whose covered period begins June 1st and ends July 26th. The borrower pays its May and June electricity bills during the covered period. It pays its July electricity bill on the next regular billing date, which happens to be August 10th, which is outside the covered period. That borrower is going to be eligible for forgiveness for the May and June electricity bills because they were paid during the period. And it will be eligible for forgiveness of the July bill, but only to the extent the charges were sort of allocable to the period ending July 26th, which is the end of the covered period. Had the borrower prepaid its July bill, it appears that the entire bill would qualify for forgiveness. I think that, that's, I don't know if John wants to speak to this a little bit. I think there's a little bit of maybe uncertainty or just a small bit of doubt still on this, but it would seem to me that the most recent guidance makes it relatively clear that, that type of a prepayment, I suppose, as long as it's not egregious, that will qualify for forgiveness, again, as long as it's paid during the period.
I think the one thing that we're going to find is, as you and I speak and people will get a feel for it, same as last time, a lot of what we're dealing with is to be determined. So what Ivan is saying is the same approach that we're looking at as far as the bill payments, the 25% non-payroll related costs. If they're paid in the period, you can end up with potentially up to three months expenses that you wouldn't have otherwise. If it's paid outside, then you have an allocation going back. Now, we get clarification on that in the next hour, the way things are changing in this program, and you're going to hear us refer to that several times during this presentation. But I agree with Ivan. As of right now, that's the approach that we're taking.
Right. And I mean, the one kind of check on that, if you will, is that, you know, there is this sort of overall limitation that says that not more than 25% of your forgiveness amount can consist of non-payroll costs. So certainly, you know, if you're trying to be, you know, egregious about it, if you're trying to prepay, you know, months and months of rent or utilities or mortgage interest, you know, it would seem that pretty quickly you're going to run up against that 25% limitation. And then the one item that the interim rule makes very clear cannot be prepaid is mortgage interest. So that one clearly can't be repaid. So if we want to advance to the next slide, please. Okay, and John, I think, so let me, this here. John, are you there? I'm not able to hear you.
I'm here, and Aaron's going to advance the slides for me as well.
Okay, terrific.
Another thing, as far as the updates that we received recently, some of what Ivan was covering relative to the egregious areas, the original application process was a 60-day bank review, but the SBA inserted a right for 90 days after that to review applications for things like egregious deductions and excess receipts on funds received based on calculations. So the SBA is maintaining the opportunity to review the applications and to require additional documentation to support situations. So where you may not have to provide all that documentation to your bank up front, you may have a request to have that documentation submitted by SBA subsequent to the bank's 60-day period. You also should be retaining your records for up to 6 years after the application process. So the bank is the first level review. For most applications, the bank's level review will be it, but the SBA still has the opportunity to come back and relook at everything if they decide they want to review an application itself. Another update that they had was related to the full-time equivalents, the FTEs that everybody's been reading about and questioning. Originally, we thought, when Ivan and I spoke last, that they were going to use a 30-hour a week for a full-time equivalent level. In reality, they've adjusted that to a 40-hour week. They've also adopted a safe harbor relative to the FTEs, and I'll cover these a little later in another slide, but brief summary, the part-timers would have to be calculated based on their hours paid, hours worked divided by 40, and they would be a fraction of 1. Anybody that worked more than 40 hours had a max of 1 full-time equivalent. And they put a provision in called a safe harbor provision where you have the opportunity to use part-timers at all 0.5 full-time equivalents rather than going through the calculation. So that was a new item that was inserted into this process that hadn't been there prior. The payroll cost eligible forgiveness, which include, as Ivan mentioned, furloughed pay, bonuses, and hazard pay, was additional guidance that was provided. He covered utility costs, and then documentation, which is what I'm going to get into next, which is the actual PPP application itself. So next slide, please.
John, a couple of questions before you advance on that.
Sure.
One is transportation still included. kind of in the bill or in the language of it? And then also, can you elaborate on what is considered payroll cost, i.e. in our contractor cases, union benefits, there's a question of, is that included, I guess, as part of payroll cost?
Sure. Transportation, although I don't know that it's been fully defined, we're taking the approach that if it's transportation equipment used in the business, then gasoline costs can be allocated to that. And to some extent, I would imagine repair costs could be allocated. I don't know if Ivan's come across anything different than that, but that's the way we look at it.
No, I haven't, and I will just say, I mean, that's one of the ones that was sort of a head scratcher. All the others are pretty, sort of plain vanilla utilities like, heat, electricity, telephone, internet access. I'm puzzled at what transportation means, because I think they refer to like a service, the service of distribution of. So it's not as though they're talking about, payments for company vehicles or things like that. So I really don't know about that one. It's odd.
We may get more clarification on that. If not, we're looking at it similar to what Ivan said and what I had said. We're looking at the gas costs and whatever for transportation that's part of the business. And I'm sure if there's an issue, the bank may address that differently. But as I also said, we limit it to 25% of the total anyway, so there will be some limitations that will apply to that. As far as payroll goes, the health insurance employer portion of health insurance and retirement plans are considered part of payroll as well. There has been no clarification as far as we know relative to the union healthcare benefits that are part of the union dues covered and the retirement plan. But we're taking the approach, and from several groups I belong to and partake in across the country, everybody else is looking at it the same way. However, that does not allow training and some of the other costs that are associated. So there's a breakdown needed on what's paid by the employer towards the union dues on a monthly basis.
Okay. Relatedly, and this is somewhat related, but are tool lease agreements for either the employer or the employees something that are forgivable?
Rent agreements aren't just for property, they're for equipment as well. So I would imagine any formal leases that were in place prior to February 15th of this year would qualify as rent expense as well.
Thank you.
Sure. If anybody else has any other questions, just jump in, but we'll go on with the application process itself. Some of the key information, we'll go through what's needed, and then we'll go through the application itself. The amount of your PPP loan, the covered period for the PPP loan starts with the date of the first fund deposit and goes for a 56-day period. Now, that's the covered period. With payroll, you've got the option, as Ivan had covered, to have an alternative payroll covered period, which would start with the first payroll after the funds are received. But again, that will not apply to the 25% of non-payroll related costs. They are covered under the covered period. You also need a schedule of the non-owner gross wages, their cash compensation, paid up to a $100,000 limit by employee for either the covered period or the alternative payroll covered period, depending on what's chosen. And the total amount that's paid to owner employees, self-employed individuals, and general partners during the covered period or alternative covered period, up to a $100,000 limit. Now, there's two tables that you'll see when we get into the application process. One is for owners' employees above $100,000, and the other is for under $100,000. When we get to that section, that's more to keep you aware of the adjustment for the $100,000 in excess, which equates to the $15,385 for the period. You could actually run the calculation by just using the first table, as long as you kept in mind that there was that limitation. Next slide, please. Thank you. The key information relative to the calculation itself the average number of FTE employees on the payroll during the base periods or the reference periods, which is how it's referred to in the Act, would include the period between February 15th of 2019 and June of 2019, or January 1st of 2020 to February 29th of 2020. That's the base that's going to be used to calculate the limitations based on full-time equivalent. If you're a seasonal business, you can pick any consecutive 12-week period between May 1st of 2019 and September 15th of 2019 There's also
and John, I don't believe that there is a definition to this point of what a seasonal business is. Is that your understanding as well?
That's my understanding, yes. We've got contractors, for example, that are pavers, and they're only working 6 or 8 months a year, they would be considered seasonal, the obvious. But as Ivan said, there is no true definition of that at this point. If the other two periods are not a good representation of what your business is, then I think it defaults down to the seasonal business for a 12-week period between that time frame to establish the base. You also have a safe harbor of getting everybody back on that was part of the full-time equivalent prior to the fund receipt as of June 30th. So that can override the other calculations as far as creating the denominator in the factor or the reference base. And Ivan, had you heard anything else relative to the seasonal businesses, or your clients looking at it differently than that?
No, I have not heard anything different. I was a little bit surprised that hasn't been defined, but I think you're exactly right that it really, it's almost like if you think you're a seasonal business and if it's favorable to you to be one, you may as well try it because there really is no definition, as far as, your sales or revenue has to vary by so much, or it's really, like I said, I'm surprised that hasn't been defined yet, but as far as I know, it has not been.
And as Ivan said earlier, in situations like this, up to this point, they've tried to err. It seems like they've tried to err on behalf of the business. I would imagine that would be the case here, as long as there's a fair representation. And if the ultimate goal was to keep people employed at everybody's business that was an applicant, so this June 30th, 2020 safe harbor would override all of the above items. So that's something that was instituted recently. It wasn't there originally. Another area that would affect the full-time equivalent, which is a relatively new addition, would be employees. For example, in Ohio, everywhere where you've got the federal add-on for the federal unemployment add-on, a lot of employees decided they were making more money on unemployment than they were making to work, and they didn't want to come back. So there was going to be an effect, could have been an effect to businesses, FTE calculations for employees that chose not to come back. And there is a provision now instituted that if a good faith written offer is made to the employee to return at the pay that they were receiving before unemployment, and they turned that down, that they would not count against the full-time equivalent calculation. At the same time, one of the requirements to use that safe harbor was you had to talk to the state unemployment department and let them know that you provided a written offer and that offer was turned down by that employee. So it's an area that the government's reserving the right to review.
One question which has been submitted is a clarification around working days or calendar days. What's a day? How do you constitute a day or week?
Well, it's a work week. It's the business's standard work week, which is how the 40 hours is measured. So if the work week includes a weekend, then it would include the weekend. But it's a 7-day, within that 7-day period, the business's normal cycle would be considered the work week. And the calculation is an average calculation, so you're going to calculate the average in that work week, and then the average within that payroll period, and then the average within that month, and the average within the months involved for the reference period or the 8-week covered period, and that's the comparative on the full-time equivalents.
Okay, thank you.
Next slide, please. The non-cash compensation payroll costs, which we covered a few minutes ago with the question that was asked. We'll go through that. That's already been covered. The non-payroll expenses during the covered period for agreements that begin before February 1st. Yes.
John, just one thing to note really quickly with regard to the non-cash compensation is that these are counted in addition to the $15,385 of compensation for employees. So if you find yourself in a situation where you've already paid an employee the maximum or close to the maximum for the 8-week period, you can still qualify for forgiveness with respect to these what the SBA refers to as non-cash compensation, like contributions to their health insurance, retirement, and so on.
And that would be true, as Ivan mentioned, for employees. Owner employees would be subject to the limitation.
Correct. For owner employees, it's only cash compensation. That's correct.
Right. Non-payroll expenses during the covered period for agreements that were in effect prior to February 15th would include the mortgage interest on real or personal property, business rent or lease payments, real or personal property, which is what we covered with Glenn's previous question, and business utility payments. The mortgage interest and real personal property and real or personal property has a little quirk in there relative, and Ivan and I had talked about this, the line of credits that you may have, whether they are or aren't covered is not really defined. The implication is it's mortgages that are secured by a specific property, but that is not what's defined. So I would imagine that line of credits that are secured by personal property or real property can qualify. Ivan, I don't know if you've run into anything else other.
I have not run into that particular issue, but I see no reason to disagree with you. I think if there's a line of credit that's secured by property, that should qualify as a mortgage for this purpose.
And I would say, similar to what we talked about, some of the other provisions to be determined, until that's clarified to be anything different, I would take that approach. Next slide. Relative to the loan forgiveness application itself, there's no deadlines for the forgiveness. However, the decision has to be made by the lender within 60 days of the application being made. The application has 4 components. There's a loan forgiveness calculation form, which you must submit. There's a Schedule A, which also must be submitted. There's a worksheet, which supports the numbers in the Schedule A, which you need to retain, along with any support for the information that's on that worksheet. And then it's optional whether you want to include borrower demographic information. There's an additional form for that, but that's not required to be submitted. The instructions ask for the employees at the time of the application, which wasn't something that had been differentiated before. It also asks for employees at the time of forgiveness application. My guess is that that's going to feed into the SBA's right for their 90-day subsequent review to the bank's review if they see huge differentiations or unsupportable numbers in either one of those areas. Up to this point, that's not something that we've been involved in tracking. Payroll schedule, whether you're weekly, bi-weekly, twice a month, or monthly, or other. Note that, as Ivan had said earlier, the alternative covered period would require bi-weekly or more frequent. So that will help support that calculation. The covered period, which starts with the first day that the PP loan disbursements were received. The alternative period, which will fall off of the payroll schedule that's applied, again, biweekly or more frequent. And then there is a box asking if the borrower along with affiliates, received loans in excess of $2 million. Again, another highlight for the SBA in their 90-day review process if they choose so to do. Next slide, please.
So there are two sort of employee questions. One is workers' compensation considered or classified as a payroll tax or part of what can be considered payroll? And then secondly, a question around annuity payments to a union fringe package. Is that considered forgivable?
The first one, relative to workers' comp, that's another one of those areas that's not determined. However, that's considered in more cases than not to be insurance, not a payroll tax. So the way we're looking at that right now, and because of the way it's treated, the majority of states as well, that workers' comp is not considered one of the state payroll taxes. State unemployment taxes would be. Ivan, I don't know if you've found anything different in Chicago than.
No, I completely agree with you. 100% agree.
And then the annuity amounts considered retirement, I would think would qualify. Again, that's not determined, that's not been defined, as has not been the union healthcare and the union retirement benefits per se. It's been a topic that's been avoided, it's been asked. So I would think if the annuities, which are considered a retirement benefit, I would probably be aggressive and take those as well.
Okay. And then just for clarification, John, and I think John or Ivan, but the documentation for the PPP needs to be retained for 6 years from the date that the loan is forgiven, is what I think I have read.
Yes.
So
yes.
Much like we keep our tax returns, in this case, just have to keep it 6 years for all of our PPP documentation.
Yes, that's what that's the stated number as of right now. Yes.
Okay.
Next slide, please. Walking through the worksheet and the form itself, a lot of the things that we've already talked about, this is the support and the actual calculations as to how numbers were arrived. The Schedule A worksheet, again, has two tables. One covers compensation less than $100,000. The other is more than $100,000, which is to emphasize the fact that there are limitations for employees and owner employees at the $100,000 level. However, you could run the calculation off of Table 1, knowing that that limitation would apply to pertinent individuals. Cash compensation is the sum of, as we discussed, the salary, wages, tips, commissions, vacation, family, medical, sick leave. Does not include leave covered by the Family's First Coronavirus Response Act, and allowances for dismissal or separations paid or incurred during the covered or alternative payroll covered period. For the most part, other than the amounts excluded due to the Family's First Coronavirus Response Act, those items will qualify. And for individual employees, the total amount of cash compensation cannot exceed $100,000 as prorated for the 850 seconds, which is the $15,385, which works out to be about 15.3 or 15.4%. Next slide, please. The line 9 on the schedule itself and asks to enter any amounts paid to owners, which would include owner employees, self-employed individuals, or general partners. Again, this is the calculation that arrives at the cap, which is for the owner employees, $15,385 or 850 seconds of the applicable compensation from 2019, whichever is lower. Next slide, please. Eligible compensation costs we've covered. Their support for that would be an ACH credit transaction or paychecks being dispersed that support would need to be retained as part of that 6-year support, not necessarily required for the lending institution at their review of the compensation process. Payroll costs are considered incurred on the day the employee's pay is earned. Payroll costs incurred but not paid during the borrower's last pay period, as Ivan had covered, are eligible for forgiveness. Payroll costs must be paid during the covered period or the alternative covered period outside of that alternative covered period, which would be the end of the 8-week reference period. I think the last couple items Ivan already covered, so I won't spend any more time on those. Non-cash compensation, which covers the lines 6 through 9 of the application, which breaks out the covered period or the alternative period. You enter the total amount paid by the borrower for the contributions for health insurance, self-insured contributions, depending on the level of the employer-sponsored group health plan, which I would include the union portion of the health plans and retirement plans. And you exclude any pre-tax contributions because those are considered part of the employee's gross pay. Line 7, you enter the total amount paid by the borrower for employer contributions to the retirement plans. And line 8, you enter the total amount paid by the borrower for employer, state, and local taxes. For many states, that will be state unemployment tax insurance only, but it would be any state and local taxes that are based on employee earnings that the employer is paying, not that are being withheld. Next slide, please. The salary hourly wage reduction, there is a provision that you must maintain employees' salaries at 75% of the pre-application period. There is a safe harbor on that. If they're returned back to 100%, then that calculation can be avoided. The calculation is used to determine the forgiveness itself. So for every dollar that's below that 75% limit would be a reduction in the amount of loan that can be forgiven. Next slide, please. The safe harbor, which we touched on the previous slide, the actual calculation, if the average annual salary or hourly wage between February 15th and April 26th is equal to or greater than annual salary or hourly wage as of February 15th, then a safe harbor is met. There's no need to go to the June 30th safe harbor that I mentioned. But if you return everybody to the employees to the original wage scale that was there prior to February 15th, then you meet a safe harbor if it's done by June 30th. Next slide, please. Average full-time equivalents, we discussed that previously, so we'll skip that slide. Keep on schedule here so we can get Ivan to talk about the Main Street loans here in a little bit. You can skip the next slide. We covered that as well. You can skip the next slide. We've covered that as well. The important thing to note there is that you can exclude employees from the full-time equivalent that were offered employment at their previous salary and refused. The next slide, the PPP loan forgiveness calculation form. On line 2 of the form itself, you enter the amount of the business mortgage interest payments during the covered period for any business mortgage obligation on real or personal property. The property has to be, it at least has to be in effect as of February 15th. And part of the support paperwork you should retain, which may not be requested by the lender or it may, would be support that their lease was in place prior to February 15th, in addition to the fact that payments were made. There are some smaller businesses that don't put a formal lease in place between property that they own, which would normally qualify or haven't been making the payments. They could lose out on this portion of the provision because they would not have the support. So it's important that if you have a related party rental agreement, that agreement be in writing, be enforced, and be maintained on a monthly basis. So keep that in mind. Utility payments, again, for the covered period for business utilities for services that began before February 15th would also be considered one of the non-payroll costs. Next slide. We've covered this too. Let's skip this slide to keep us on schedule here. Loan forgiveness then, as far as the calculation, line 8, you enter the amount, the actual calculation on how much is forgiven and how much is not, with a limitation applied for the full-time equivalent employee reduction flows through this portion of the schedule. And what you're going to find with this application is the form itself is really a single page application, and then a second page has sign-offs attesting that the information that was provided is accurate. The balance is the instructions and the support sheets, with Schedule A being the only other item that has to be retained. So some of these items we've discussed on these calculations should be retained, might be asked for as support by the lender, may not. But again, you want to keep that for 6 years, and the SBA reserves the right for 90 days after the lender's approval to re-review the process and determine if they agree with the findings. The line 9, you enter the actual PPP loan amount, and then line 10 is going to calculate that 75% of payroll requirement and limitation, because 75% of the funds have to be spent on payroll, and 25% of that number then can be spent on non-payroll related costs. Next slide, please. So to review, the documentation that's required would be Schedule A, would be cash and non-cash benefit payments and payroll payments. Suggestion, have bank statements, payroll service reports, tax forms, payroll tax forms like Form 941, payment receipts, canceled checks or account statements, or bank statements that show the ACH transactions, and as well as support for employer contributions for health insurance and retirement plans. FTE, you should maintain support and have support available that the lender may request for your calculation of the base periods or the reference periods, depending on the periods that were chosen, as well as the safe harbors, if the safe harbor is what's being utilized to overcome some of the limitations on the full-time equivalents. And the non-payroll support that should be maintained would be leases and documentation to show that the obligations that are being used on the non-payroll costs applied towards leases or obligations that were in effect prior to February 15th. Lender reports and amortization schedules or canceled checks, which would support the mortgage interest, lease agreements and canceled checks or lessor statements to support the lease payments, and utility invoices, canceled checks, or account statements that show the transaction being removed from the bank, from the funds. Okay. Ivan, I'll turn it back over to you for Main Street Lending.
Sure. And we have just literally a couple of minutes left, so I'll try to just kind of cover this very, very quickly, just cover the kind of the high points of it. And I would certainly recommend that people, take a look at the slides, certainly I'm happy to answer questions if people want to reach out to me individually if they have particular interest in this program. I will say just very, very quickly before we turn to this, there was a question about having to defend the need for a PPP loan, and I think guidance we got about a week or so ago was extremely helpful in that it basically says if you received a loan of under $2 million, you will be presumed to have had a need for the loan essentially. And if your loan was more than that, the SBA will look at that question, but if they determine that you did not have a good faith basis for applying for the loan, generally the only penalty, if you will, is that you will be required to repay it according to the usual schedule. You will not be looking at, civil or certainly criminal penalties, except in cases of, outright overt fraud.
Interesting
that
enough,
said, let me
I'll make this real quick. The $2 million mark, which was the automatic review, conflicts a little bit with this 90-day review process they put in, because they said they also review the right to look at loans under $2 million during this 90-day review process. But I don't think it's so much for defending the loan as it is for having support relative to the loan. So.
Right. So let me just really quickly talk about, so this Main Street Lending Program, it's a program that is going to be run directly by the Fed. And the Fed is going to make the Treasury Department is going to make a $75 billion investment in a special purpose vehicle that's being organized by the Federal Reserve Bank of Boston. They are going to purchase up to $600 billion of eligible loans. So just like with the PPP, you would apply for this through your normal lender. You would not apply directly to the Treasury or the Fed or anything like that. You would still go through your lender. If we could go to the next slide. These loans are, they are not forgivable. So unlike PPP, they don't have that, incredibly attractive feature of effectively converting into a grant. There are actually going to be 3 separate Main Street programs, which vary slightly. They can make loans of as little as $500,000 and as much as, I think, $200 million. So there's obviously PPP loans were capped at $10 million. So there's a much greater, breadth of these loans and the potential to have vastly larger loans. And in fact, whereas PPP loans generally are limited to employers with 500 or fewer employees, these Main Street loans can be made to businesses that have not more than 15,000 employees or not more than $5 billion in 2019 annual revenues. So and these can be in addition to PPP loans. So for borrowers who either already have a PPP loan and need additional funding, or for borrowers who either didn't apply or couldn't qualify for a PPP loan because they were too large or for other reasons, this could be an option. If we can go to the next slide, I'll just cover this very, very quickly. Generally speaking, let me skip ahead even one further. Let's see. Keep going down. I'm looking for, there's a slide with, keep going till we get to like some of the general terms of the loans. I want to talk about what the terms are. Here we go. So generally speaking, while there is some variation across the 3 programs, these are going to be loans that are repayable over 4 years. The interest rate is going to be LIBOR plus 300 basis points or 3%. Right now, LIBOR is quite low, so you're looking at an interest rate of about, I think, 3.25% to 3.5%. Interest and principal payments can be deferred for a year, and there's no prepayment penalty. As I said a moment ago, though, there is no forgiveness. So these are real loans in every respect, and they will have to be paid back. But for businesses that, again, have need for capital over and above a PPP loan, these are an option. This program is not operational yet, but we did hear just within the past few days that the Fed apparently intends to begin making loans under this program within the next couple of weeks. So I think, in the time we've got, those are sort of the highlights of the program. I would say again that I'd recommend you take a look at the slides, and certainly, if there are questions or interest in this program, please don't hesitate to contact me.
Thank you, Ivan and John, for sharing your insights today. I feel and know from the questions that were asked that it was a very interesting and important topic for members to kind of hear, and I think you clarified as much as you could, provide good guidance and direction. I would encourage members who might have an interest to feel free to reach out to John or Ivan or communicate through Courtney Smizer or myself if you have any specific questions. This webinar again has been recorded and will be posted, shared on our website. We will also get a copy of the loan forgiveness application to also include on our website as another resource, and maybe the Main Street Lending Program, just if nothing else but a link to some additional information. So again, thank everyone for being with us today. There will be another webinar next week, which will focus on kind of the employers reopening and return to work. And it's kind of case studies from a couple of different employers, construction employers, on what they've transitioned to. There's also a architectural perspective or presentation as part of office spacing and layout design. So I think that could be another important webinar topic. And then June 10th, you'll see there's another legal session that'll be coming up in terms of what to expect from construction business. We're actually planning for late June an industry panel, so with leaders from the architecture, construction, engineering industries, giving their take and perspective upon the industry going forward. So again, appreciate everyone being involved, and certainly appreciate both Han Lozier and HW and Company for their lending of talent, or John and Ivan. Appreciate that very much, and wish everybody a great day. Thank you.